And now towards the accrued expenses of the adjustment of the accounts. So business may incur expenses before they pay cash. Consider an employee's salary. So, for example, Starbucks expenses and payable grow as the employee work, so the liability is said to be accrued, right? Another example is the interest expense on, for example, notes payable. So, interest accrues as the clock ticks. The term accrued expense refers to a liability that arises from an expense that not yet been paid. So here company recorded the expense before cash payment. So sorry, accrued expenses are often recorded as salaries, taxes, interest, rent. So it recorded at the end of the period using adjusting entries as well. So let's explore that one further. So in case of salaries, most companies pay their employees at a set time. For suppose Friday's Auto Service Incorporation pays its employee a monthly salary of $1,800, half on 15 and half on the last day of the month, right? Here and here. The following calendar for June has been paydays circled. So assume that if the paydays fall on Sunday, then Fridays pay the employees on the following of the Monday, right? Means they cannot pay on Sunday as it's a holiday, so they would be paying in 1st of July, right? Because 30th June, after that there is 1st of July, right? But salary has been incurred but not paid. So for June, Friday's paid its employee the first half of 900 salary. The entry would be salaries expense to cash because you pay cash. And when you post it, the posting gonna be salaries expense debit. So here it is debit, cash expense credit, it is here credit. But the problem is when you pay on July 1st, you need to make an adjustment of the entries. That is salaries expense to salaries payable. When you close the books, you close the books on 30th June, right? It would be paid on July 1st, but you are now on June 30th. On June 30th, you are not paying that one. You create a liability, that is salary expense to salary payable. No cash is involved, so when we post it, the answer would be expense has been increased to 1800 and payable is 900, right? Now moving towards the accrued revenue in adjust the accounts. So business often earn revenue before they receive the cash. So a revenue that has been earned but not yet collected is called accrued revenue. So the tagline is the revenue recorded before cash is received. Accrued revenues often occur in regards to service performed but cash is not received, rent and interest, rent income or interest income. Interest occurred but you did not receive the interest yet. So let's do some illustration. Assume that FedEx hires a Freddy's on June 15. You highlight the date. So FedEx will pay Freddy's 600 monthly when the first payment on 15th of July. During June, Freddy's will earn half a month fee for the work done on 15th of June through 30th June, right? So Freddy's basically already earned its $600 monthly. So half of the month fees, which means half of the month fees, which is 300, because they have already performed the work from June 15 to 30th. So on June 30th, Fridays will make the following adjusting entry. That is, they're gonna record the income that 300 as a service revenue. Revenue is a part of retained earning. So when retain retained earning is a part of owner's equity. Owner's equity increases, which means credit. And since FedEx becomes their customers, so Fridays has to receive money from FedEx. So we create account receivable. Account receivable is our asset. Asset increase, debit. Entry would be account receivable to service revenue, and then we post it. So that is the previous balance 2200, and now you add 300 here. So service revenue previously we have 7000, now 300 is new balance on June 30th. So just stop for a while. I just want you to pause the video and try to solve this by yourself, and then we solve it together. Okay, suppose here Friday's Auto Service Incorporation holds a note receivable as an investment. At the end of the June, $100 of interest revenue has been earned. It means has been earned but not yet received. So generalize the accrued revenue adjustment here. So we earn the revenue in revenue. So answer would be revenue increase credit, but we did not receive yet, so we create a receivable. So our entry would be interest receivable to interest revenue 100. Let's see that the answer here. Yes, interest receivable to interest revenue, right? 100. And now let's discuss unearned revenue. So some businesses, they collect cash from the customer before earning their revenue. This creates liability, and we call that unearned revenue. So only when the job is completed does the business earn the revenue. So it means cash received before cash is recorded. Unearned revenues often occur in records to customer deposits, airline tickets, magazine subscription, and rent. So when you purchase the airline tickets, the airline company, they receive the revenue in advance before they provide the service, right? So till the service has been delivered, they categorize this airline ticket receipt as liability. So in order to understand the unearned revenue, let's understand it through an example. Suppose Home Depot engages Friday's Auto Service Incorporation to perform routine oil changes on Home Depot trucks, agreeing to pay Friday's 400 monthly, beginning immediately, which means they pay the 400 immediately. So if Fridays collect the first amount on June 15, then Fridays record this transaction as follows: as unearned revenue, which is cash to unearned revenue, because they receive cash increase assets, asset increase being debit, and unearned service revenue, which is liability increase credit. When you post this journal entry, so cash is going to be debited here, and unearned service revenue, which is a liability, it is credited with 400. And now the June 30 unadjusted trial balance list unearned service revenue with the 400 current balance, right? This one, June 15. But now we're talking about June 30. So during the last 15 days of the month, Friday will earn one half of the 400. So this 400 by 2, which is 200, the Freddy's will already earn, or 200 will earn. So on June 30, Freddy's will make the following adjustment. So don't confuse with this 7,000. 7,000 is the previous balance of service revenue. So earned revenue, which is 200. Why? Because liability decrease means debit, right? You earn that revenue, so you adjust the unearned revenue side. So it means this is 400, 200 you earn, so you have to balance it out 200 here, right? In that case, you're going to have a 200 balance here, right? So in that case, entry would be unearned revenue to revenue. Now you are officially claiming the part of the unearned revenue as revenue, right? Entry would be unearned service revenue to service revenue. Half of 400 you claim as a revenue. So revenue increase, credit, and liability decrease, answer would be debit. So entry would be debit to credit, so unearned service revenue to service revenue. So when you post here, it would be 200 here and the balance is 200 here as well, right? And we're gonna increase our sales with 200 as well. Good. So don't confuse with this 307,000 because they are previous balances.